In this video, we're going to look at the new exclusion of unemployment up to $10,200 per taxpayer. But what we want to do here is look at what they call the $150,000 cliff. I've already done a video, I just did one on how to calculate the amount of your unemployment that is excluded from income. This is kind of the follow-up to that. And what I want to look at is that the rule says you can exclude up to $10,200 or the amount of your unemployment, whichever is lower, per taxpayer, as long as your income, your modified adjusted gross income, is under $150,000. So in that other video I referred to, and if we can look here at the worksheet, we went through and did an example, a live example of a 1040 here. We did all the calcs. I don't want to get into that right now. What I want to do is explain a concept. But what we did then is we worked up the return. We did the complete return over here. Then what we did is we got down to the adjusted gross income and we started to work what we call the unemployment exclusion worksheet. If you're looking at material prior to March 24th about how to calculate your unemployment, it is wrong. Please go see the video I've got posted below. We just did it after they came out with guidance. This guidance came out as of yesterday. So please make sure you're on the right worksheet and make sure you're following the right instructions, because the IRS a couple of weeks ago put out totally wrong instructions on how to calculate what we've done here. So what happens on this worksheet, the first 7 lines, and I'm going to take this little yellow pad here and cover this up, but these first 7 lines of the worksheet is doing nothing but figuring out your modified adjusted gross income. Now, what we did on this return here, if we look about what is your modified adjusted gross income, it ends up being here $74,180. If I look over here on my 1040, it's actually 74,000. I put right here. The 74,180 matches our modified adjusted gross income. Now I can tell you the reason why that happened, because actually had our unemployment not been taxable, would have been taxable, we would have added the 6144, the unemployment, in. But because it was not taxable, over on adjustments to income, I'll pull this out of the way. If we look here, what happens is that 6144 is income, but now we get to back it out off the worksheet. So the net result is our modified gross income, 74,180, is before unemployment is added in. And because then we got to exclude it on the worksheet over to Schedule 1, it was not part of our adjusted gross income. So the point of it is the proof here is that when I look at the worksheet and I see 74,180 matched to 74,180, I know the tie up. So this is the foundation. We did this return again in another video. Based on this 74,180 was underneath the threshold. So then what I did is I took this same return and I added to it $75,000 to it. When I did that, I'm going to move this off. So this was the return we did in the prior video, and we were at 74,180 modified adjusted income. Now what we're going to do is we're going to come over here, and all I did is run this same return. So we're not going to throw all the detail. We want to just look that we just added $75,000 to income. What did that do to our modified adjusted gross income? Well, what you're going to find out, this is by increasing income by 75,000 over our original return from 74,000. In doing that, our modified adjusted gross income is 149,303. So let's look at line 7 here. Is the amount on line 6 150 or more? No, it's not. So guess what? In conclusion, we're going to still get the same $6,144 that we got in our first example. Remember, in our first example, I'll just lay the worksheet right here. Here's the 75 and here's our new worksheet. We added 75,000, I'll leave this pin right here, to our income, and we put it at 149, just shy of the 150. our amount excluded is still $10,002 per taxpayer, or the amount of unemployment per taxpayer, whichever is less, on your 1040 for 2020. And if you're married filing joint and both taxpayers received unemployment, both taxpayers can exempt up to 10.2. But the important takeaway here is we're right at $149,303. So we're less than $1,000 from this cliff. So what happens whenever I take this same return and instead of 75, I do 76? See, before I did 75, now I'm going to do 76. Well, guess what? This particular software that I use, once you go over, so we went from, again, from 75 right here to 76, my software doesn't even produce a worksheet to see the results. So what's this mean? Is that when I took this original return and I ran the income up to 149, as you can see here, 149,303, we still got that same $6,144. But when I added $1,000 to it, guess what? On this return, there is no exclusion worksheet because our modified gross income went over the 150,000. So again, as you can see, 75. If we increased our original return by 75,000, we were at 149. All we did is go from 75 to 76. I'm repeating myself because this is the takeaway. This is what you need to take back with you. Just that amount of money. Technically, $1 could cost a married couple up to $20,400 of taxable income. $1. If you don't call that a cliff, I don't know what a cliff is. So at that point in time, you got to think about if somebody's just above that 150,000, how to pull them back down. And again, this 150,000 is for all taxpayers for being under that 150 to qualify for the exclusion of this amount of money. So again, this is in summary, just shows you that $1 can be worth $20,400 in tax excluded income if you hit that magical $150,000 modified gross income. And again, where do I find the definition of modified gross income? It's on the unemployment exclusion worksheet, which you can, I'll move this out of the way. You can see it right here. And it's the first 7 lines. And then you do your test right here. This number here, 150, is really your modified adjusted gross income in concept without your unemployment. That's the key to the law. Hope this little video talking about the cliff, the 150,000, ouch, helps. And again, if you're just over that 150, you probably need to do some tax planning and look at things like retirement, contributing more if you've got a small business, more 179 expensing, but we can save that for a later video. Well, I'm finally glad the IRS before April 15th got out some guidance that was correct. Stay tuned, hope this helps. Hit that button, look forward to the next video, and thank you.